Hello, Rachel here from Beautiful Budget. Welcome back to our channel. I am very excited about today's video because this one goes out to all my TSP brothers and sisters. The Thrift Savings Plan, essentially the 401k for federal employees and members of the uniformed services. Now, I served in the Air Force for about 6.5 years, and I actually opened a TSP account around year 5 of my career. Better late than never, right? By the time I opened my TSP, I was getting really intentional with budgeting, and I was learning a lot about investing and really making sure that I had a good foundational understanding so that I could confidently invest inside of my TSP, which is the first thing I ever started investing in. And so, of course, I'm thinking here, there's got to be other people. If you clicked on this video, then you're probably right there where you're like, I would like to have a better understanding of this account and how to wisely invest inside of it based on my goals, the time I have till retirement, etc. That's what this video is about. Before I get to the juicy stuff, if you are interested in learning more about budgeting and how you can use it as a bridge to building wealth and shaping the life of your dreams, this is a channel for you. This is a platform for you. So be sure to click that subscribe button so that you don't miss a beat when new videos get dropped. Now, I'm going to cover all of the different investment options, all the different selections that you have inside of the TSP, but I think it's great to start with just kind of a foundational, how does this account work? Kind of mentioned earlier about how it's a 401k equivalent. So what does that mean? What do we know about 401ks? Well, this is an employer-sponsored retirement plan. So this is not a 401k and a TSP. You can't go open these by yourself. Your employer's got to sponsor the plan, and when funds are contributed into it, that money is already taken out of your paycheck. So by the time your paycheck hits your account, all of that contributing has already happened. Now, of course, you've got to log into your pay portal and set those percentages, set those amounts of what you want to contribute. And when you go and you set those amounts of what you would like to contribute, here are a few things you want to keep in mind. First up is Roth versus traditional. You're going to see these words on the screen. And I just want to kind of give you a quick rundown of what these mean. So when you're putting your money inside, you kind of got a choice here when it comes to the TSP. Do you want to pay taxes on those contributions now? Or do you want to hold off and maybe pay taxes when you go to pull money out, when you go to withdraw funds? That is the distinction here. With traditional, what you're saying is, I do not want to pay those taxes right now. Maybe you're saying to yourself, I'm in a pretty high tax bracket right now. If I have the option, I'm going to go ahead and not pay taxes now. And later on, when my taxes are lower, because you're predicting that your taxes will be lower when it's time for you to retire, I'll go ahead and pay taxes then. That's traditional. Pre-tax dollars. Your contributions are pre-tax. They're tax deferred, meaning that you will face that tax bill later, but you're not going to pay the taxes right now. Versus Roth, the Roth flavor, if you will, is you are going to go ahead and pay taxes now. Maybe you're thinking, hey, I'm in a pretty favorable tax bracket right now. I don't think my taxes are too high when I compare to what I think it'll be when I retire. I think it'll be higher. So I'm going to go ahead and pay my taxes right now. That's kind of the logic that goes into, am I going to choose traditional or am I going to choose Roth? And you can choose a combination. You can choose a mix of the two and kind of set your percentages that way. But even beyond kind of your tax landscape, you want to keep in mind that there are contribution limits to the TSP. So the 2022 annual contribution limit for your thrift savings plan is $20,500. So you cannot put more than that amount inside of your TSP without facing penalties, right? So they have capped how much you can put in. So you'll want to do the math to make sure that when you're setting the percentages or setting the amounts, that it's not going to exceed that amount for the year. Now, to go in and set your contribution amounts, kind of choose traditional versus Roth, that is only the beginning. That is only scratching the surface. You've still got to go and actually select your investments. You've got the candy bag, which is your TSP account. It's time to put some candy in it and pick which candy you want. So that is going to tsp.gov, getting your account set up, and selecting which funds you want to invest in inside of the account. Before I talk about what your different options are inside of the account as far as what you can invest in, let's cover the basics of stocks and bonds. Even just a quick rundown of what these are and how they differ. is going to put you in a nice position to make a sound decision about what you choose to invest in and kind of the risk you're taking in some of these sorts of things. So we'll start with stocks here. To purchase a stock is to buy ownership in a company. A stock is equity. So when you go and you purchase, an Apple share, you are now becoming part owner of Apple. You have ownership now in that company because you have invested in their stock. Versus a bond is quite different. I want you to think of a bond like an IOU. This is a loan from the investor to the issuer, could be a company, could be government, and this entity, let's say it's the government, is going to use those funds and you as the investor are paid interest. All right, so they're quite different. We're talking about ownership versus an IOU. Very, very different. What's also very different is the kind of overall risk. Now, here's the thing. There are many different types of risk when it comes to investing, but I want to speak on a very just kind of general level. If you are on, the Vanguard website or the, Fidelity website, and you're talking about kind of researching investments, you'll see a risk meter. Usually it's a scale of 1 to 5. That's kind of the general risk I want to talk about is on the surface, what is it riskier to invest in terms of, am I going to risk losing the initial money that I put in? Am I going to risk losing my principal? And that risk is greater with stocks. All right. The future of that company, how it performs, right? There's a lot of volatility that can happen inside of the stock market. The ebbs and flows of the market. We hear about that all the time, right? Versus with bonds, these are considered much safer investment instruments. And when we think of this quote, high risk, high reward, I want you to kind of keep that in the back of your mind, that concept. So when we think about the safer investment instrument, we've got, lower risk, lower returns. That's what you're going to see when it comes to bonds. Right? Versus when you invest in the stock market, and especially if you've got a lot of time on your side to kind of ride out the ebbs and flows of the market, there's a higher return potentially for you on the other side of that because you're taking on more risk. All right. So stocks and bonds, having just a foundational understanding of what they are and how they work, there's risk with both. Now, I did kind of a money quiz in my Instagram stories the other day, and I posed a question in regards to, a stock index fund, and I'll talk about index funds a little bit later in the video, compared to a US Treasury bond and which one was riskier. Well, you kind of got what you need to know already to kind of say, well, in general, like stocks are riskier than bonds when we talk about just a general concept of risk and what somebody, on the street would say, okay, which is riskier? The stock is riskier. But a US Treasury bond, this is actually considered a riskless investment. This is a bond. I mean, that principal payment going back to you, that's backed by the US government. They're saying, yes, I'm going to give you back your entire initial investment. You're going to get paid that interest, right? That's the structure with bonds. You can rest assured that you're going to get that money back. But here's the asterisk. You've got to hold that bond until maturity. Think of that as like its expiration date. All right, so bonds have maturity dates. Assuming that you held that US Treasury bond all the way through to its maturity date, you're going to see your initial investment back. All right, so we consider that a risk-free investment, a US Treasury bond. All right, so I just want to kind of spend a couple minutes to clarify that question from the money quiz. But now we've got a good kind of foundational understanding of stocks versus bonds. And this is good for us to take with us into the discussion about what can I invest in inside of the TSP. So here are your options. You can choose between Lifecycle Funds, aka L funds, or there are 5 individual funds. And we're going to cover each of these, but I want to start with the Lifecycle Funds. These are target date funds. What does that mean? Well, when you look at these on the tsp.gov website and you're kind of browsing through and you're researching, okay, which one is right for me, you're going to see that L is followed by a year. You want to treat that year. That year would represent the approximate time frame that you anticipate you will retire. So when my husband and I opened our accounts and we were selecting our funds that we wanted to invest in inside of the TSP, we went with the Lifecycle 2050 funds because 2050 is about the time that we plan to retire. And so here's how this target date fund works. This is an excellent option for beginner investors especially, but those who really want kind of a hands-off approach to the whole thing, here's what's happening inside of this target date fund. Is, first of all, you have some mix of the 5 individual funds inside of an L fund. All right, so I haven't talked about those 5 individual ones yet, but just know that there's a blend of all 5 of those inside of that L fund. And what's happening is, as you approach your retirement years, so for us, 2050, this portfolio, this fund is being rebalanced. I prefer to say de-risked, right? It's being de-risked as we approach 2050, as we approach retirement. And that makes sense, right, when we think about it, because we don't want to take on as much risk. Most of us don't. We don't want to take on as much risk when we're getting ready to retire. And we want to be able to have those funds ready and there for us to use to kind of get through our retirement years comfortably. We don't want to risk losing all of our money at that stage in life. So over time, the fund goes from being maybe, heavier in stocks to leaning more into bonds. Remember, because I said that those are the safer investment instruments. And so it's going to lean more into those, and the percentage of bonds is going to be greater as we approach 2050. So you're going to want to look at that year that follows that L, and you're going to want to say, okay, that's about when we anticipate retiring. That's going to be a good fund for us, because around that time frame, around that year, we're going to see that our portfolio is not taking on a lot of risk. So here's what's great though, is because you have this blend of the 5 individual funds, you're getting that kind of inherent diversification, you're getting a nice mix of different things, but you also don't have to be actively inside of your account rebalancing and saying, oh man, there's too much stock percentage in here. Like, this is way too deep in stocks and not as deep in bonds. I'm in my 40s and now I want to adjust it. You don't have to do that. That is happening for you in the background, and that is how target date funds work. They are rebalanced as you approach that objective or target date. So hands off there, like I said, you can absolutely click on each of these L funds and see what the exact percentages are of each of the 5 funds. If it's 44% C fund, 27% I fund, and I'll get into what those mean in a second, but you'll see the exact composition, how this fund is kind of made up of the 5 individual funds. So let's dive into these 5 funds. Now, what you're going to see me do, here's kind of the trend that you're going to see, the information that I'll give you for each of these, is I'll give you just kind of a general description of what each fund is. Then I'm going to give you a 10-year average annual return, meaning what is the investor getting back, right? Because you invest your money, you see this, interest growing on your investment, and then what happens is interest is earned on interest, and this is called compounding. Compound interest has been referred to as the 8th wonder of the world, because, and you'll see these when you look at these charts, is you'll see an investment, and you'll see this growth, and then you'll just see this explosion once, a good amount of time has been put in, that the investor has put in, and then it just kind of explodes. And that is the power of compound interest. That's why time in the market is such an asset, right? It's not about timing the market, it's about your time inside of the market. Then I will give you the average annual return since the fund was created. And then, okay, if I invested $100 when the fund was originally created, what would I have as of October 2021? All right, so those are the kind of the 4 things that you'll get with each fund. That'll give you kind of a general description, the 10-year average return, the average return since the fund was created, and what $100 invested back then would be as of October 2021. All right, so first up we have the G fund, and this G is for government securities. So within this fund, we have a lot more of those, safer, lower risk investments inside. And this is a fund that you're going to see that's appropriate for those who want to preserve their capital. They want to preserve their money. They don't want to lose their initial investment and take on a lot of risk, right? And so I talked about how target date funds, they get de-risked as you approach that objective date, that target date. As you're approaching that target date, you are going to be more inside of G funds. You're going to see that your kind of balance there is leaning much more into G funds because it's safer there. When we look at the 10-year average annual return for the G fund, 1.97%. And to put that into greater perspective here, your, typical legitimate high yield savings account these days, you're probably getting 1 1.1%, 1.25%. So this G fund isn't performing much better than that at 1.97% over the last 10 years. So the look of defeat, you know, for some of my bosses or my boss's bosses who realized, oh my gosh, a lot of my money has been in the G fund. I haven't even really been investing. So I gotta say, in this case, that G does not stand for gangster. That G is like, you might want to go cry in the corner for a little bit because your money has basically been in a glorified savings account. That's what I'm talking about there. So I gave you the 10-year average annual return, 1.97. Since the fund was created in 1987, the average annual return has been 4.68%. I mentioned how the last figure I'm going to give you for each of these really tells the story the best, and that is, okay, if I had $100 in 1987, when the fund was created and I invested then, what would I have in October of 2021? And the answer here for the G fund is $495. So over that time frame, you know, May of 1987 to October of 2021, we've earned just shy of $400. So let's go into the second fund here. This is the F fund, F for Fixed Income Index Fund. I'll stop here to talk about what is an index fund. Why are they so highly regarded? Why do people keep talking about index funds? Well, here's the thing. Let's break down those two words. So index. When you hear the word index, I just want you to think of a list, a roster. Right, so a common index that you'll hear about, the S&P 500. S&P stands for Standard & Poor's. This is simply a roster of companies. The S&P 500, specifically, is the leading approximately 500 companies that are publicly traded in the US. And by leading, I mean in terms of market capitalization. What does that mean in everyday talk? It's basically the top 500 companies in the US. That's what you're looking at when you see the S&P 500. That's what the S&P 500 is. It contains those companies. So to invest in an S&P 500 index fund is to put your dollars towards all of those companies in one go. And that index fund is designed to match the performance of the index that it's named after. This is great because, again, you know, diversification. You're getting exposure to different things. Not only that, index funds are passively managed, and that means that there is not somebody behind the scenes needing to kind of, you know, say, okay, we got this stock, and then we're gonna, okay, let's sell it and buy it, and let's do this other activity here, and let's kind of speculate over here. All that stuff doesn't need to go on because, again, it's an index fund, so it's designed to match some roster. And here's the thing, nothing is ever free, right? You go and you invest in these index funds, whether it's inside of the TSP, whether it's inside of your IRA, there are fees involved. And the administrative and the management fees related to this investing that you're doing, that's called the expense ratio. And the expense ratio for a lot of these really popular index funds is very low. And we would expect that, right? Because there's not a whole lot of managing that needs to happen. So that's also what makes index funds so attractive to investors. So let me circle back to the F fund is the Fixed Income Index Fund. So what is the index that it is designed to match? That index is the US bond market. All right, I mentioned bonds earlier. When we look at the 10-year average annual return for the F fund, 1.79%. So it's actually a little bit lower than the G fund for the 10-year average annualized return. What is it since the fund was created, which was actually 1988? 5.53%. If $100 was invested in January of 88, what would it have grown to October of 2021? That answer is $709 if we're talking about the F fund. So the G fund and the F fund, they were created a year apart, but you have to compare, even though the F fund's 10-year average return was a little bit less than the G fund, over that longer time horizon, there was a greater average annual return. So $100 actually grew to be a bit greater than what we saw with the G fund, which was about $500. So up next, this third fund, this is where the definitions and the concepts I've been talking about, this is where it's going to kind of show up in neon lights and it's going to click, right? Let's talk about the C fund, the Common Stock Index Fund. This is designed to mirror the performance of the S&P 500, which I was discussing earlier. So to invest in this index fund is to invest in all of the companies on the S&P 500 in one go. The 10-year average return for the C fund, 12.96%. And just to kind of illustrate here, I mentioned how it's designed to mirror the performance of some list. Okay, well, how did that list actually perform over that same 10-year period? 12.96%. So in this case, that construction of that index fund, I mean, to the 100th, it matched what it was constructed to kind of perform in accordance with, 12.96%. So that's great. That's what we like to see, is that our index fund is performing just as it's designed to. How has it performed since 1988 when the fund was created? 10.48%. Right, so that is fantastic. All right, so let me really bring this home with my $100 growth example that I continue to give. $100 invested back in January 1988 into the TSP C Fund would have grown to $3,716 in October of 2021. From $100 to $3,716. That is noteworthy growth. That's something to write home about. When you go and you open up your 401k, you go and you open up your TSP, you're hoping to see these kinds of numbers, especially when you know that you have a nice long time horizon on your side. All right, now these last two funds, these were created in 2001, so they're a bit newer. The fourth fund is the S Fund, S for Small Capitalization Index Fund. This is designed to mirror the performance of the total stock market. And so that is all of your US equities. So the 10-year average annual return that we've seen for the S Fund is 10.37%. How did the total stock market actually perform? 10.12%. So it wasn't an exact match, just like we saw with the C Fund, but still, this is good. This is what we want to see, is that our index fund is performing how it is constructed to perform. How has the S Fund done since it was created, which was back in 2001? That return has been 8.4%. So $100 invested in May of 2001 would have grown to about $800 as of October 2021. Keep in mind, it's a newer fund, right? But those are the figures that we've captured for the S Fund. The final fund, number 5, is the International Stock Market Index Fund. And probably don't need to tell you, this is designed to mirror the performance of the international stock market. 10-year average return for the I Fund, 5.78%. Since the fund was created in 2001, 4.28%. $100 invested in May of 2001 inside of the I Fund will have grown to $300 by October of 2021. Right now, remember, you can go to tsp.gov and you can definitely drill down even more into each of these funds, look at different figures instead of just 10-year and overall. You can see 1 year, 3 year, 5 year. But here's the thing to keep in mind. Historical returns. Don't really take this as, okay, history is going to repeat itself. This 10-year period looked like this 10-year period is going to, it's going to match that. Instead, just know that there's a rhyme to it, but it's not exactly repetition. Take that perception, that thought with you when you're looking at historical returns. All right, awesome. We talked about lifecycle funds. We talked about the 5 individual funds that you can choose to invest in inside of the TSP. Keep in mind that it doesn't have to be just L funds or one of the 5 funds I talked about. You can choose your mix. You can kind of mix how you want to, but in the do-it-yourself approach where you're kind of picking your own and choosing that mix, just remember that you're going to have to be the one that goes in and rebalances over time. All right, my final tidbit here. Let's say you move on to a position and your TSP is not relevant here. You move on past a job that includes the TSP. Know that you don't have to move your money out of there and transfer it to a different retirement account. You can absolutely keep those funds there. That's what my husband and I did. And a lot of our reasoning behind that was the TSP has an advantage over lots of other 401k plans in that its fees are much lower. I talked about the expense ratio and how that's your admin and management cost associated with investing in certain funds. Let's take the C Fund inside of the TSP. It has a 0.042 total expense ratio. So for $1,000 invested inside of the C Fund within the TSP, 42 cents is what it's costing to invest in that way inside of that fund. All right. And just know that when you break down the fee structure, TSP versus most other 401ks, you're going to see that the TSP is the more favorable choice, but definitely look into that, look at your numbers, compare. For some people, it's less about the fees and more about simplicity, kind of consolidating everything into one place, and I can certainly respect that, but just a different perspective there in case you really want to make a decision based on the numbers. That would be something to look into. And a disclaimer here, I'm not a financial advisor. I can't tell you exactly what to invest in. Wouldn't be legal of me to do that. Would be a huge compromise to my business. So I'm not doing that. Definitely do your research. Hopefully this video was helpful though, in exposing you to what are my different options inside of the TSP and, broad brush, what do they mean? And what are the things I might want to consider when I choose my investments? If you found this video helpful, definitely click that like button, hit subscribe so that you can be notified when more videos get dropped surrounding personal and family finance, wealth building, and tackling your financial goals while still leading a life that you love. Let me know in the comments if you are a TSP account holder, if you are, how you've learned to kind of navigate the account, if you plan on keeping your funds there after you move on. Let's chat in the comments and stay tuned for more finance content. Thank you for tuning in. I'll see you next time.